Welcome everyone, and thank you for joining today's Hotel Investor Marketplace webcast produced by Hotel Brokers International. I'm Tony DeGeorge, President of HBI and President of Green Canfield DeGeorge LLC, and I appreciate you joining us today to hear Jeff Higley's presentation. While everyone's getting signed in and comfortable, I'll share a few items. Founded in 1959, Hotel Brokers International is the leading network of real estate brokers specializing exclusively in the hotel real estate investments, providing every phase of hotel brokerage process from property evaluations to closings. Visit HBI on the web at hbihotels.com. To ask a question during today's webinar, just type in the Ask a Question box located below the webcast player. We'll answer as many as time allows. We also include some attachments and links under the attachment button. The attachments will be available throughout today's webinar, as well as available later today when the recorded event is posted on demand viewing at hbihotels.com. We want you to also give us sort of a grade on this. Let us know how we're doing. You can do this by going to Rate Today's Webcast by clicking on Rate This at the Rate This button at the bottom of the webcast player. Under the Details button are tools that you'll be able to use for sharing the webcast through social media accounts. We invite you to please do that. Now I'd like to welcome our speaker, Jeff Higley. Jeff is a longtime friend of HBI and has specialized in the hotel industry journalism for many years. He oversees all aspects of Hotel News Now digital platform, including their website and daily newsletter. Jeff also leads the STR family of company efforts with corporate public relations and press releases, and frequently writes articles on the lodging industry. Welcome, Jeff, and welcome to our webcast.
Thanks, Tony. Appreciate it. Always a pleasure catching up with you and Sherry and Glenda and the rest of the HBI team. As you said, it seems like the years have gone by pretty fast, but it's been a great relationship, and I value it very much. And I appreciate you asking me to be part of this webinar today. And for the record, I already voted a 10 to rate this webinar, so we know we have one 10 on the board already. So,
well, thank you. We appreciate that.
So you know, as we closing out the year, you know, it's been quite an interesting year for the hotel industry as Marriott and Starwood have started coming together as a unit after last year's acquisition. We've seen a lot with supply and demand and occupancy, continued consolidation in the industry, and the list can go on and on. So it's been, and obviously the political climate, what's going on in Washington, tax reform, other things that are coming down the pike that will affect the hotel industry. It's going to, as a journalist, it's going to be fun to watch and to report on what's coming up. So I've got about 40 slides here to go through. I'll walk through them pretty slowly, or pretty quickly, sorry. And certainly if there are any questions along the way, you can ask them as we go. This presentation will also be available on the Hotel News Now website. It's free. Simply you have to sign in or register with your name and email address is all that requires. So you'll be able to get it that way as well. I do want to apologize in advance. Usually for this presentation, I'll have a few slides that talk about transaction volume, et cetera, for the year. And I don't know if all of you know this, but Steve Hennis, who was with us for a long time, left STR in the summer. We do have somebody that's getting up to speed replacing him. However, I don't have that information available. I will be at your conference in February, and we'll have the data for you then. So in some ways, that might be better because I'll have the year-end data. But I do apologize up front for not having that data for this presentation. So without further ado, we'll get right into the to the action here. You can see that we saw 2016 was a record year all the way across the board in all of the key statistics. Keep a look at the percentage changes and how they will change here as we start presenting 2017 data. So far this year, the demand growth is holding nicely, and if you'll recall at the very beginning of the year when STR, when CBRE and PwC, we all had a little bit more subdued demand projections than what actually has happened. So the demand number that has been recorded throughout 2017, I think has been a pleasant surprise for all of us and has really helped elongate this cycle that's going on. But as you can see, we're still in positive territory for all 5 key metrics that go along with the industry. I think if you look at beyond the demand, RevPAR still around 3%, ADR up 2%, and occupancy still at an all-time high of 67.6%. And this will be repeated throughout this conversation, but that means 2 out of every 3 rooms in the hotel industry are filled every night. That's a pretty powerful statement when you think about that and the ramifications that it has throughout the industry and all of the things affiliated with it, including the broker world that you all are part of.
You're absolutely right, Jeff. I mean, that really shows the strength of the market right now.
It does. It put it certainly puts the pricing power in the hotel's hands because and obviously we know that the hotel industry is a street corner business. No matter how you look at it, no matter what discipline you're part of, it's all about how your street corner is performing, and most of them are still performing very strong, and that's that's good news. We'll have there's a few numbers that are a little bit concerning that we'll get into a little bit later, but by and large, it's just a fantastic time right now, and these numbers bear that out. If you look at the October 2017 data, which is the latest data available, we'll be crunching November data in about 4 days. You look at October, RevPAR up over 4%, ADR up 2.5%. The highest number of room nights sold in the industry in October ever, with 111 million room nights sold. Group RevPAR up 5.7. Here's the thing that's the most interesting, and we'll talk about this a couple of times during the next 45 minutes or so. The number of rooms in construction stage actually declined, albeit it was very, very slight, minus 0.1%, so essentially flat. But that's the first time since 2011 that we didn't see a year-over-year monthly increase in the number of rooms in construction. There's a lot of reasons for that. The big question is what effect does the hurricanes have on this? We had Houston, we had Florida get hit really hard, and the question of are subs, are contractors and subcontractors available to do some of the other construction work that was on the books, or is that construction work put off to the side while everybody heads to these storm-ravaged areas, where insurance payments are in, and frankly they can command a little bit more money for their services. So we think that has a little bit to do with it, if not a lot, and we'll be watching that closely to see how that pattern plays out over the next couple of months.
And Jeff, I think you're really right on that. I mean, we have a property in the Keys in Florida, of course, one of the hardest hit areas, and what we know is that just on the island of Marathon, there's about 400 rooms that just don't exist any longer, but all of the rooms out there from Key West all the way to Miami need some type of work, and they're still, sort of having a hard time finding all of the contractors they need to do windows, replacement of roofs, interior work. So I think you're right on target in what you're saying.
Yeah, Tony, to me, that's the most interesting thing. I talked to an owner of a pretty big resort down there, and he wanted it all off the record. But what he has to replace, the windows where the water was coming sideways. Who would think that the window seals would and would go, and that would you'd have to replace all your windows. But the biggest issue down there, and I think it's the case in South Texas as well, is mold. You get that water in there and it sits for a week or 10 days, or in some cases longer. You're going to have to deal with mold, and then that that takes that property out of circulation for in a lot of cases up to 6 months.
Right.
Or even longer. And as we said, then all those subs come down to do that work, and they're even finding it difficult to find all the subs they need. Well, where are they coming from? They're coming from the other areas in the country, and so construction kind of stops or rapidly slows down in those areas. Now, it hasn't completely stopped, as I'll show some slides later that show some pretty amazing numbers what's in the pipeline. But at least for the time being, we're seeing just a little bit of lull in that construction activity. And then you can see this is presented just a little bit different way. You can see actual ADR is 127 for 2017. That's that 2.1% increase we were talking about. There's the occupancy again. So again, this has been a great run. And October numbers, when we started the year, people thought at some point this year we're probably going to see the cycle at least slow dramatically down or end. And here we are in December. I don't see November's numbers being too far off from what October was. So here we are at the end of the year, and this cycle is as strong as ever. Here's some market. Here's a slide, and this is interesting when you talk about how major gateway cities can affect the industry, and we look at New York, San Francisco, and Miami, all of which have some supply issues. San Francisco, was compounded by the convention center being offline for so long. But if you take those three cities out of the equation, the U.S. RevPAR would have been 3.2%. With those in the equation, it's 0.4 of a point lower at 2.8%. So you can see how dramatically these big markets can affect the hotel industry, and this is a great example of that. Same thing if you look at October and take out Florida and Texas, where we just talked about all that storm damage, and the demand that was created after the storms because of insurance adjusters and contractors and FEMA workers, and the list goes on and on of what those types of catastrophes attract in terms of guests. If you take those out, we have that 2.3, but you look at Florida and Texas, with double-digit RevPAR growth because of that, certainly influences the overall performance. Also, would be remiss not to note the the religious holiday change of dates and how that affects performance as well. Of all the slides that we presented STR, this is the one that I always, and you guys have all probably heard me say this probably more times than you can you care to remember, but this is a slide that tells it all to me. When you look at that blue line, which is demand, and the red line, which is supply, every time the red line goes above the blue line, the industry is in trouble. When supply growth outpaces demand growth, that's not a good equation for the industry. And you can see earlier this year, they were literally right on top of each other, and it looked like we were headed toward that scenario taking place where supply was going to just surge ahead of demand growth. But demand got a second wind, and I think it fueled a little bit by that, by what we talked about in the storm aftermath, just as well as just a strong summer of vacation travel. And so now you've got that gap again where demand is, looking, if the trajectory continues, you know, looks to be like it's on its way for another nice rise, and supply looks like it might bounce along at that 1.8%. And I always find this interesting because all of the talk in the industry for the past, really, I'd say 18 months has been about this supply growth and what it's going to cause in terms of how it's going to affect the industry. But right now, when we're talking about this year-to-date supply growth at 1.8%, that is the average growth rate of supply since STRs began tracking it 29 years ago. So we're right at the average. So, not for me to answer, but I guess the rhetorical question is are we really in that much of a bind when it comes to supply? I think that the beauty's in the eye of the beholder there. If you're building, you look at it with the glass 3/4 full. If you're already in the market, it may be 3/4 empty because of the supply that's coming on board. But this is always is a great slide that kind of puts everything into perspective, I think.
Well, and I think you're also showing how long of a run this has been. This has got to be an industry record for the length of time, without a downturn.
Yeah, you're right, and depending on what metric you looked at, I've got a slide coming up about the RevPAR run, and we are approaching record territory, and some people may say we are. The last thing I'll say about this slide is, I've had some people propose over the course of the last year that the cycle doesn't have to be negative for it to end. Can you have a cycle end while everything's still positive, and then you just start the upward trajectory again, and that's the beginning of your cycle? Now, I don't know if I necessarily prescribe to that theory, but it certainly is interesting to, it'll be interesting to see over the course of the next 6 to 12 months if these numbers start, to follow the trajectory that they're on right now. A case could be made that the bottom of the cycle or the cycle ended at some point middle of this year and we've started a new one. That's going to be fun to watch and get a lot of comments from CEOs and brokers and Wall Street guys, on whether that's true, because I think you're going to see, definitely be a 50-50 split whether that actually can happen.
But I think you're right. 95 by your chart, it looks like that's what happened.
That's right. That's right. So here it is again with occupancy and ADR data back to the beginning of time for STR, and you can see the ADR has been kind of bouncing along, a little bit declining, while occupancy has slightly risen. And again, the question is, it's not our role to say whether or not. But let me rephrase that. It appears that there's some pricing power still left on the table for hotels, in this environment. When you have occupancy still strong, the ADR can follow. And here's that slide I was talking about, Tony. You can see this is RevPAR growth going all the way back 1990. We are now in 92 consecutive months of RevPAR growth. It'll be 8 years in March if we make it that long. You can see the last two cycles. Now, the little caveat there, in that previous, the 111 months, if you looked real close there was a 1 month period where it dipped below, where it dipped negative, and for a long time we were presenting this slide as those being two distinct separate periods. But as we've talked about this and we decided that really just an aberration like that shouldn't be considered an end of a streak. So it's 111 months there. We're closing in on this. What's that? By the time it's 11 and 8, so we're 19 months away. Sometime in 2019, we could reach that 111 months if everything stands pat. But it's interesting to look at these slides and the volatility of the downturns, that have been pronounced, particularly the last two. It'll be interesting to see how that next one develops.
Well, we're hoping with all the tax cuts and all the taxes that are going on, if those pass, we'll see an increase.
That's that is the $1 million question, right? I mean, any tax cuts or I should say tax reform and any other programs, that are pro-business, could that fuel this to become, a really lengthy run? And again, I'll go back to that, that question of, did we hit bottom, and bottom just happened to be positive this time? That'd be, if that's the downturn, what a great, what a great
way to go.
Have. That's right. That's exactly right. That's exactly right. So here's the question. Some of the things that we're watching. The number of sub-markets. We talked a little bit earlier about, we all know this is a street corner business, and we can look at top 25 markets, we can look at the big markets, but what's going on in the sub-markets, and the number of those that are starting to show negative RevPAR year over year, that's something that we're just keeping a watch on. We're not saying it's a big issue just yet, but it certainly is something that is worth noting and keeping track of, because as those submarkets go rolled up, submarkets comprise a market. So it stands to reason that if enough of the submarkets are negative, those markets in general will turn negative as well. Excuse me. And then of course we have by chain scale segment, you can see that the upscale and upper mid-scale segments are by far and away the most active when it comes to supply growth and demand growth. And that's a theme that will be played out throughout several slides coming up, particularly when it comes to the construction area. What is interesting to note to me is that supply has actually declined a little bit in the economy segment. So that's is that a sign that some of the the obsolete buildings that just no longer are useful at all, but are still in prime locations, or at least good locations, are they being bulldozed to make way for the next Home Depot or Lowe's or Menards, whatever your home improvement store of choice is.
That's true, though. That's a good point.
Well, I'd be interested to hear, from some of your members, because I know that, some of the sales that you see, are some of the older boxes still finding life. So I'd be interested, maybe when we're out in Vegas in February, we can talk a little bit about what you guys are seeing in that. What's on the market in that area? Are your clients now starting to say, yeah, I can sell more, I can make more money if I just sell it to big box company as opposed to trying to keep it a hotel?
No, that's true. Although if you look at what and I know you were at Red Lion just a week or so ago, they actually now have the Signature Edition to sort of pick up those properties and sort of bring them back to life. So it's just interesting. It'd be interesting to follow up on it. And you're right. We'll talk about that in the future.
Yeah, that's an interesting brand. I don't want to say I'm promoting one brand over another, but I find it interesting that a company is embracing particularly those exterior corridor, 2-story expressway type motels, whereas for the longest time they were kind of viewed as not the most desirable proper product. But I think Greg and Roger and those guys are looking at it as a way of, hey, there's so much of this supply out there, why not take advantage of that and utilize it to their advantage? So yeah, that's an interesting brand, and I hope it does do well, because some of those properties, still have a lot of character to them.
Absolutely.
So you can see on this slide how ADR growth is driving RevPAR growth in these various chain scale segments. The occupancy is in blue, and then ADR growth in red. And I guess, to kind of continue to build that economy property type of story, not only, is there a flattening of the supply growth that's in there, but you can see that those hotels are above average in terms of industry ADR. They're above the 2.3% and above all the other segments. So they're able to use that pricing power a little bit to their advantage, because their occupancy has has risen slightly. Now mid-scale is still the leader there at 1.2%, and then you've got the upper mid-scale, which you guys know a lot of those. That's the the Hampton Inns and those types of properties. You look at that occupancy change and you kind of wonder, is that occupancy not higher because of the supply that's coming in, into that market, into that segment, and has that supply, just not been absorbed by that segment yet? But with all the talk about economy, mid-scale, upper mid-scale, we all know that the upper end still drives the industry. As the upper end goes, the trickle-down effect is most definitely in play. So you look at those luxury, upper upscale, and upscale segments selling, 70% of the rooms in those segments, well north of that, including the upper upscale, which is 3/4 of the rooms. So the success that those segments are having certainly is a big reason for the success of the hotel industry overall.
I've got a quick question for you. I mean, is that part of just the economy doing so well that people just don't go to the economy brands? They sort of trade up during good times and sort of trade down during bad times?
I think that's probably a very good a way to look at it. Although, just going from memory, Tony, I think that this is kind of a trend that bears out throughout cycles, whether it's an up cycle or down cycle. Now, the numbers may drop. It may not be 7 out of 10 rooms, but it still seems that upper end is, a little bit higher on the occupancy side than the lower tiered products, and I think that's a lot driven by business travelers, and
sure, the
what
corporate
they want
guys.
to stay in. Yeah, what is that, OPM, where they use other people's money? They'll stay upper upscale, but they're the same guys staying at the at the La Quinta on vacation, because that's their money.
That's
right?
very true.
So look at this, starting to get into some transient versus group business. You can see the transient demand has continued to rise. It's kind of leveled off. Meanwhile, the ADR has kind of stayed steady, bounced around that 2% range. And this is a classic case of your demand is higher than your ADR percent change. Your demand growth is higher than that. Is there some pricing power left on the table that hotels aren't taking advantage of? This slide would indicate there very possibly could be. And then same thing with group. You can see let me rephrase that. Here's the data with group, where you can see the demand is far below the ADR. So group business, which generally is booked further in advance than transient business, has been able to hold steady with around that 3% ADR percentage change, while also the demand has been roughly flat with that Jewish holiday shift in September there, being a bad thing for that month. Now I will say I was at a meeting with some sales and marketing people in Washington. HSMAI had their sales and marketing group meeting, and in general, what they're telling us is that that booking window for groups continues to shrink. So what may very well happen is that that ADR number could go either way. It could go way up or way down, because what they also said was that the groups are coming, they're booking in the month for the month. So they're coming the 1st of November and saying, hey, we have a meeting in 3 weeks and I need you. So the hotel can be aggressively pricing that kind of business, but they don't want to chase it away because they know their competitors will gobble it up. So it's a fine line that they have to walk, and they want to make some money, but they don't want to to scare their customers away. So that's going to be an interesting dynamic to watch throughout 2018 as well. How group business performs, and has there been a just a general shift in booking patterns long term for that sector? And then we look at the how ADR, how the group and transient compare. You can see that the group is in that light blue color, and it generally, there's a gap that stays pretty consistent regardless of what's happened over the past 24 months. Shifting to some markets, these are the top and the bottom 5 of the top 25 markets in ADR percent change. Let's look at the top 5 first. Nashville's just been a market that it just continues to amaze. That upswing has gone on now for a good 4 or 5 years, and the latest trend that is really helping drive it are bachelor parties. Fly into Nashville on any Friday, and you guarantee you'll be on a plane with several bachelorette parties whooping it up and ready to go. You guys have all seen them, those pedal carts that have bars on them.
Absolutely.
They pedal around Nashville. There's almost traffic jams with these vehicles because of all the bachelorette parties that are taking place and on these things. But that is really one of the things. Of course, the new convention center a couple of years ago helps fuel it. But it just shows that the attraction of Nashville has kind of expanded to continue more groups, and that's why the occupancy has been at 75%. Year to date, and ADR has gone up 6% to lead all the top 25 markets. You can see Detroit's also had a great year. Washington, driven by either support or protest, groups going in, and that's helped fuel that. And then Orlando and Seattle both have enjoyed that year. Seattle is going to be interesting because they also have a lot of construction in the pipeline, as does Nashville, and we'll see how that plays out. Now, conversely, on the other end of the scale, if you look at Miami, down 2.6%, basically because of the new supply, and same thing for New York there. And we talked about San Francisco as well, down 2% because of that long period that the convention center. Because I just read something, it was probably a couple weeks ago, where they said that business is slow to come back to San Francisco, to the convention center, and they haven't pinpointed why yet. Maybe it's the rate for the hotels. I don't know. And then you look at Minnesota, or Minneapolis, St. Paul, and Philly. Both with big events that affect those cities in different ways. So here's the snapshot of the pipeline. You can see the flat in construction year over year for number of rooms. Final planning, that's still the wild card. Still 15% higher this year than last year. So if that all comes to fruition, we'll see this flattening of the number of rooms in construction. That'll be a fleeting number because of all the things that are still in the pipeline. But if you look even further out, that just in the planning stages, that very early stage of development, it's relatively flat. So that really could be a good sign for the industry that, whether it's lenders that are tightening their belts or developers that just start finding the right opportunities, whatever the reason is, that's starting to stabilize a little bit, and that could again help us elongate this this cycle. So that's good news.
It is really good news, and it might sort of prove what you were saying about contractors being drawn to other areas just to do the renovation that's hurricane from Texas, Florida, that, they're in other areas. It's just hard to get them to build right now.
Yeah, at least short term. So, I mean, if we are truly looking at, that mold and all that is a problem of let's just call it 6 to 8 months of a time frame. Once they find the subs, you're looking at sometime, let's just say middle of next year, where those subs and those contractors will be available to go back out, and that maybe that's where that final planning, those properties and projects in final planning get their jump start.
True.
Excuse me. And then you look at this where we're looking at the percentage changes in red year over year. There's that negative, or let's call it flat. Let's say what it is. But the number of rooms in construction has been kind of bouncing along. It certainly is well below the peak in February, where 194,000 rooms were in construction. So again, it's just a good story whenever you can see that number stabilizing and not continuing to grow. At least it's a good story for industry metrics and performance. Might not be a good story for investors and builders and lenders and all that, but as far as metrics go, having a good stable 160,000 rooms would be good.
Right.
It's also well below the prior peak of all time, when we saw those 211,000 rooms in construction in December of 2007. That was you guys all remember that. That was 100. Heck, there were some deals that were 110% LTV and higher, which was just absolutely crazy, and probably was part of the reason that big drop-off came. But it seems like that's being held a little bit more in check, which is helping to keep the supply growth at least a little bit more reasonable than what it was during those those really gaudy days of 06, 07, and even early 08. Okay, let's see. There we go. Now, looking at the construction projects in a different way, this is again a number of rooms in construction, but you can see that the number of rooms, 83% of them come in that are in now the four lower chain scale segments, as well as unaffiliated, those 19,000 rooms. The majority of them will become upper mid-scale properties, but right now they're just not affiliated with a brand. So you can see that dominating. You don't see many, large-scale, big box hotels being built. It's predominantly those, cost-effective 100, 120, 150 maybe room Hamptons, Garden Inns, Spring Hills, residents. You got
Courtyard. I mean, that's what, as a broker, that's what we're hearing all the time. Show me a Marriott product and it'll be sold very quickly. Simply, that's the demand is out there.
Yep, that's right. I mean, I think it's generally accepted that if it's a Marriott or a Hilton, some cases Hyatt, that's the case. They do go pretty quickly. Now, I will say, I don't have this slide, but I will say consistently, Holiday Inn Express is at the top of the pipeline list. So there's a lot of Holiday Inn Expresses in the pipeline, and then you have your Hamptons and right down the line with all those Hilton and Marriott brands. But I always found it interesting that Holiday Inn Express is always up there at the top of that list. And then looking at the same slide, you can see 2/3 of the rooms in construction are in those two segments, upscale and upscale and upper mid-scale. And those are just the brands we named and a lot more. But, you know, it's those, let's call it select service, where you don't have room service, you don't have big F&B operations, you don't even have a lot of meeting space. These are, you know, those properties that take 12 to 18 months to build, and you slap them up and you get them in service. So that's exactly what's going on.
And sort of the corporate traveler dream, right? I mean, that's what they're all sort of fitting into.
Well, corporate travelers who like loyalty points, and
right.
You're talking to one of them. I am a point monger, let's say that, and I've chosen mine, and I stick with it pretty regularly. And yeah, I know those select service brands for that company pretty well.
There you go.
And you know, it's so yeah, that loyalty and the effect of loyalty programs and what they've had on the consumers, which therefore affects performance and development, has been astounding in the past 10 years. You know, it's really driving a lot of the development because the demand generator is there. And you know, I think if you ask Arnie Sorensen, Marriott, that was one of the key drivers of that deal for Starwood. You know, that database of great names. So we talked a little bit about the large metro areas. You know, for the longest time, it was New York was leading the way. Well, they kind of put a lot of their rooms into circulation. New York is still up there at over 10%, almost 11%. But Nashville now, 13% of existing inventory now. There's 13% more in the pipeline, and it just seems like every day there's a new one being announced. The JW Marriott's going to open sometime late spring. I think that's 600 rooms. We'll be having our hotel data conference there in 2019 and 2020. So there's my shameless plug for the day. And they just announced a Margaritaville. I think that's going to be 250 rooms. That's going to be in that same area. The tri-branded property, the Marriott tri-branded property, is getting ready to open soon. So, you know, there's just a lot of action going on in downtown Nashville. Same thing with New York, you know, Seattle, all that activity that's being built around, what is it, Google, that's building their headquarters in the downtown area. You know, just
right.
the residual effect of all of the things that go along with a major construction project like that is changing the face of downtown Seattle. You also have Denver, Dallas, you know, with just a lot of things in the pipeline. So, you know, if you're in those markets, that can be a little scary. And then we thought we'd look at it a little bit broader. You know, we always talk about the top 25 markets, but let's look at the MSAs here real quick. So when you're talking about Nashville, you know, it includes Murfreesboro, Franklin, et cetera. As you can see here, almost 100% of that supply is coming into downtown. Then you've got places like Savannah, Georgia, you know, which has a very high. They're building, I think, that Riverwalk, the power plant, the old power plant. I think, Kessler Collections, turning that into an autograph. Then you've got, you know, some Florida, et cetera. There's Seattle. So when you take the whole New York MSA, including Newark, Jersey City, you know, the percentage of pipeline, it goes from double figures down to about 8%. So I just thought this was interesting when we were talking about sub-markets before. So when you're tying all this stuff together, you can see the effect of, you know, the ramifications of this kind of supply growth. And then the pipeline, the top 26 markets have almost half the rooms in construction right now. So, yeah, developers want those urban, high barrier to entry markets to build in. And taking a look at our forecast here, you can see we've got, we showed a little bit of the performance at the beginning. Now to 2017, we're seeing supply forecasts end at about 1.9% and be about 2% next year. Remember, that long-term average is at 1.8%. And then you can see, I won't read all of these, but you can go down the list. We're projecting occupancy to be about flat, so topping out at that 67.5% area, and then ADR again. All things considered, ADR growth, RevPAR growth north of 2%. When we were all thinking that this was the year that things were going to fall apart a little bit, all things considered, that's not too bad.
No, I think you're exactly right, though. I mean, everybody, a year ago or even a year and a half ago, we're not predicting to be where we're at right now. So that's just great news.
Yeah, I mean, in a lot of ways, there was a lot of doom and gloom in the industry. 2017 was going to be it, and we were going to have to start from scratch. And it's just been really amazing that it's continued to go along as strong as it has. And here's a point. These are the chain scale segments and how everybody's doing there. Again, if you look down at the economy sector and the mid-scale sector, where there's 3% RevPAR growth down there. If that's if that's the bottom of the cycle, I think hotelers would take it every year, every time, if that's what your downturn is. And then looking to 2018, same thing. We're a little bit more muted on RevPAR growth, not 3%, but still north of 2%, particularly for those, the economy and mid-scale segments. And then this is the forecast for 17 and 18 from the three companies that generally do these kind of things. These are based on August forecasts, so they'll be shifting sooner than later as the first of the year. But in general, you can see that everybody's around that same number in supply, demand, occupancy, and all the key indicators there. So we all think it's going to be a fairly similar year next year to what we've experienced this year.
Have any of these numbers, or have they put in the number thinking about tax change, or the new tax programs that may be out there for small business and things? Has any of that been in consideration, or do you think they'll change any of these numbers based upon tax relief coming if it comes?
I don't think they've been that's reflected in these numbers yet. I think what you'll start seeing is the projections that are released at Alice will have those thoughts included. I don't know whether whether tax reform will have a major impact on hotel performance, at least in the early going. I think as all that tax, it really won't take effect till 19, right? That's when all the numbers will really start coming in.
True.
So it'll be interesting to see how corporations, if they're getting these big tax reductions down to, 20%, if that's what it ends up being, does that mean they'll put more people on the road, put more people on the payroll, therefore, more traveling salesmen, et cetera, et cetera. That's what really remains to be seen.
Right. Absolutely right.
And then here's the North American markets, how they fall for our forecast for the end of this year for RevPAR. As you can see, most are in the middle, but we've got some over here in 5 to 10%, and some that will be a little bit in the negative. I think more telling is 2018, where we see almost every one of those top markets being in that 0 to 5% RevPAR gain. Again, if you're looking at 2 or 3% growth in what's supposed to be a down year, that's not a bad position to be in. And finally, just wanted to take a quick look at these are the top stories that we've had through November on HNN, and if you look down this list, they're all about change. They're all about uncertainty. They're all about, just things that are going on in the industry, that's changing the face of the industry in one way, shape, or form. So I just thought it would be interesting to kind of pull things together where, the industry's going through a lot of different changes, as we talked about at the beginning, and this kind of really summarizes, what that means, or what it means to our readers anyway. And so a couple key takeaways: we're still at record-setting levels. Pipeline's focused on limited service. Demand is still rocking. RevPAR growth will come from ADR because we see occupancy leveling off. There's no downturn in sight. We might bounce along at 2% RevPAR growth, but hey, that's okay. And rapid change is the new norm. You really don't know what's coming tomorrow, because it could be a tweet away from, greatness or disaster. We just don't know. But what we do know is that it's going to be different from day to day. So that is, I think, yes, that is it. Thank you very much for having me again, and I could stick on for any questions if there are any, or
I don't see any questions.
Cleveland Browns, if anybody wants to.
Along the way that we've had, but we certainly want to thank you, Jeff. We appreciate all the information you always bring to the table, and we look forward. A number of the people that are, I'm sure, on this webcast are looking forward to seeing you as well at the Alice conference. You always will update your numbers and give us the best numbers. So we certainly appreciate you and appreciate STR for all their help in the industry.
Well, we're happy to do it, and we're happy to be partners with HBI, and look forward to any chance we have the opportunity to interact with you guys. It's always great.
Excellent. Thank you, Jeff. And just to let our viewers know that don't forget, we'd like you to rate our session today. So if you go to the rate button, which is located at the bottom of the webcast player, we'd appreciate that. Also under the attachments, don't forget we have at the bottom of the webcast player downloaded select hotel investments for everybody to look at, and you can print those out. They're listings from HBI brokers. And don't forget to click on the detail button, which will enable you to share with your colleagues this webcast. And remember, this and previous Hotel Investor Marketplace webcasts are available on demand at viewing at hbihotels.com. A couple weeks ago, we had sort of the super way to do a 1031 exchange. That's just one of the minis that we have there, so go take a look at those if you haven't. We look forward to seeing a lot of you at the upcoming events. As Jeff and I were talking about, the most current one that we'll have is in January in Los Angeles. You can contact the HBA office if you'd like to schedule a meeting with myself. I will be there. And of course, Jeff's email is there if you wanted to maybe set aside a time and talk with him, or, I think you'll have all your questions answered by Jeff at his presentation. He always does a great job. So thank everybody for watching this, and have a great day, have a great holiday, and we look forward to seeing you very soon. Thank you.